Hello everybody and welcome to P7 class 7 out of 8. Would you believe we're getting towards the end of the course? Of course. So this is class number 7. I'm still struggling voice-wise. Yes, really. I am still struggling voice-wise, so apologies, but there'll be no tie today. I've been tieless all day. Just gives my throat a bit more of a chance to be less restricted. What else do I need to tell you? I need to tell you that we have been spending a lot of time on chapter number 4 because chapter 4 has several different areas of examinability in it, including the two biggest ones. So we've spent a lot of time with chapter 4. We're going to finish off chapter 4 today and also get through chapter 5 and chapter 6, would you believe? So things pick up a bit of pace here. Chapter 5, auditing of group accounts, takes almost no time to get through. And chapter 6 is pure revision of stuff you saw on the F8 paper. So the knowledge side of chapter 6 takes virtually no time to get through. So the plan for tonight's class is as follows. We are going to finish the knowledge and theory of the finalisation stage of the audit in chapter 4. Just a reminder, chapter 4 is made up of 3 things. It's made up of planning the audit, which of course we did, and we've looked at business risk, risk of material misstatement. Business risk, the risk of damage to the company. Risk of material misstatement, the risk that their accounts might be wrong. Spent a lot of time on that, very important topic. We then looked at audit work questions. And we took a look at the question first so we could see what sort of style it was. And then we've been ploughing through accounting standards to see what sort of accounting knowledge from your F7 and P2 could come up. Now we've got a few of those accounting standards left, but they are revision. To be frank, I really shouldn't have to cover them, but I do because I think it makes a lot of sense to do so. So we'll be covering those, I think, on our final night next week rather than tonight. Tonight, we're going to be picking it up towards the back of chapter 4, go through audit finalisation, a series of audit standards, each of which could come up for about 5 marks. Usually on the exam, only 1, maybe 2 of these will make an appearance. It's not a major mark getter. But we'll go through all of that. And then before we get on to the final bit of the audit report, we'll jump out of audit process and just ask ourselves, how does auditing change if instead of auditing one company, we are auditing a group of companies, meaning consolidated accounts? So off we go then, my little friends. Okay, let's go look at chapter 4 of the class notes. Hi. Ooh, is that a new name? Don't think I've seen that one before. So chapter 4, just a reminder that we started with audit planning. We've done all of that. We then looked at audit evidence. And we've done all of the audit evidence side of that. It's just some of the accounting rules which we've got left to do. But we'll fly past all the accounting standards. Whoa, almost got it right. And this is the last things we were doing last time. Page 68. So what I'll do is give you a quick reminder of completion phase, some of which we did last time, and then we will plough on to the end of the chapter. So I think last time, if my memory is correct, we did look at management representations. A little reminder, this is ISA 580. Auditors get their evidence by doing audit tests, A, E, I, O, U. And the E is inquiry, which makes us wonder, who would you inquire of? Who would you ask? Well, we can ask third parties to confirm things, but sometimes we have to ask management to make representations or statements or promises, if you like, to us. And then we will go and get other evidence to back up what management is telling us. But what management is telling us is part of our evidence. It's not the most compelling or reliable evidence because it's management giving it to us. But there are some things where we have to get them to confirm things. So, as it will say on the page, but just to give you some examples, where there are estimates in the accounts, right at the end of the audit, we want to go to management and say, look, you've estimated these things. Can you still confirm to us that you believe those estimates are the most appropriate given what you know? We will go to management and we will say, can you please confirm to us that there are no court cases that you've not told us about, no contingent liabilities, no related party transactions? Can you confirm to us that in your opinion the company's a going concern? Anything which is a matter of opinion, it's an estimate, anything where there's a risk we might not have seen everything, get management to confirm in writing. For the exam, therefore, getting a management representation is often something that will earn you a mark when you're talking audit evidence, as long as you are specific and say what the representation is meant to say. Don't just write, get management representation, that will get you nothing. If you say, get management representation confirming their belief that all related party transactions have been disclosed, good. So that was 580. And then I think we finished with 560. But 560 is very important, so I'm just going to go over it one more time with the picture. So ISA 560 looks at a subject called subsequent events. So there is your client's year end. And then after the year end, in you come to do your audit. So there's the final audit. And towards the end of that process, the directors sign off the accounts. And then almost immediately afterwards, we get the audit report. And everything is fine, but we have a potential problem. At some point in the future is the AGM. That is where the accounts are put in front of the shareholders and they vote to say, yes, we accept these accounts. The accounts are then officially registered with the authorities. The problem is the gap. The fact that there is a gap between the directors signing, the auditors finishing, and the shareholders then authorising. Because there is potential in that gap for an error to be discovered. Now, it could be any error. It could be absolutely any reason. But one of the reasons we get errors in there is the fact that we have these things called events after the reporting period. And those events, as we know, can be adjusting or disclosable. And the difficulty that this causes is that if these events are happening all the way up until when the directors sign the accounts, there is a danger that something happens just before the directors sign, but the directors don't yet know it's happened. They only find out a few days, maybe a week or so later. So there is a danger that problems in the accounts are discovered too late. So what do we do if that error is discovered? Well, it all depends what the directors do next. And as we saw, if the directors decide to put this right and they sign corrected financial statements, then we as auditors have a problem. Because the audit report has got to be dated after the financial statements, because you cannot report on financial statements if they don't exist yet. And the other reason why the audit report must be dated afterwards is to take account of the fact that events after the reporting period are happening from the year end up until the directors signing the accounts. And you can't consider all the potentially adjusting or disclosable events until after the IAS 10 period has come to an end. And the problem with this is that when the directors correct the accounts and print a new set with a new date, IAS 10, which had stopped here, now extends all the way up to there. And so as auditor, you are going to have to extend your audit work from the date you first signed up until a new date to check whether any of those events in that period are adjustable or disclosable. So there we go, that is IAS 560. If anything happens between the year end, before you sign the audit report, not a problem, you can mention it in the audit report. The difficulty is when things happen after that. If you want to talk about them, you could go to the AGM. If the directors reissue the accounts, the existing audit report is now null and void, and you need to issue a new one at this new later date. Okay, good. So going back to the class notes, after 560, and there is an example in the notes to help guide you through it, by the way, we move on to another audit standard, 720, other information. As with all the standards we're looking at the end of chapter 4, this was and is on the F8 syllabus. So you should have seen this before. And it works like this. When companies produce their financial statements for the shareholders, many big companies, the listed companies in particular, don't just send accounts. Attached to the accounts will be an annual report. And that annual report will include things like a chairman's statement, corporate governance disclosures, report from the audit committee, stuff like that. It will also have information about the company's social responsibilities and environmental responsibilities, thanks these days to the joys of corporate social reporting. In fact, to make matters more interesting, whereas in the past you would have the accounts, the social reporting and the environmental very much separated, often referred to as triple bottom line or the 3 E's, or 3 P's, profit, people, planet, that sort of stuff. The way this is now moving forward is called integrated reporting, with companies now encouraged to produce an integrated report demonstrating how the company has behaved and how its strategies work by looking at all of these elements combined. Now, all of this is creating issues for us as auditors. We audit the accounts, fine. But if information in the accounts is also being presented in other parts of the annual report, and if that information being presented is not being audited in that other part of the annual report, because most of the annual report is not subject to an audit. What happens if the accounts say something, you audit the accounts and the accounts seem to be correct, but elsewhere in the annual report the same information is being presented with different data? So, simple example. You've audited your client's accounts. It's almost the end of the audit and you're happy that the accounts are true and fair. Included in the company's accounts have been some charitable donations of 1 million. But in the integrated reporting section of the annual report, it talks about how the company is very keen not just to generate profits for shareholders, but to generate profit to be paid back to society. And it points out that it's made $10 million of donations this year. Well, you've audited this company and they have not made 10 million. They've made 1 million. Someone has fallen asleep on the zero key and added it by mistake. Or at least that's what you think's happened. So you go to the directors and you say, guys, I notice you say 10 million of donations there. I've checked your accounts and trust me, you've not donated 10, you've donated 1. Well, that's all great and hopefully the directors say, oh yes, that's a mistake and they correct it. But what if they won't? What if they say, look, auditors, your job's to audit the accounts. The annual report is up to us what we say, go away. They refuse to change it. If there is something in the unaudited sections of the annual report which is wrong, you cannot put this in your audit opinion because your opinion is an opinion on the accounts. This is not the accounts. This is something else attached to the accounts. So the way we get around this is by using something called an other matter paragraph. The opinion will still say the accounts are true and fair, but underneath the opinion there will be an additional paragraph saying something like this. On page 64 of the annual report, in paragraph 2 of the company's integrated reporting, the directors refer to charitable donations of $10 million. Having audited the accounts, we believe the correct figure is $1 million, and this is reflected within the financial statements. Our opinion on the financial statements is not modified in this respect. So the accounts are fine. It's nothing to do with the accounts. This is the other information. So if you're going to give if you're going to look for inconsistencies, you're going to have to read the other information, aren't you? So the idea is, before the audit finishes, read the draft copies of the annual reports that the company is putting together. And if you find any inconsistencies, ask the directors to change them, and if they refuse, other matter paragraph. But what if the company has not finalised its annual report yet? Because they don't have to before the audit's finished. What if the chairman's not written the chairman's statement? The integrated report is not finalised yet. Well, if that's the case, your job is to read whatever's available. If necessary, read the rest of it before the AGM, and you can always tell the shareholders at the AGM instead if there's a problem. And that is ISA 720. Again, example in the notes. I've given you my own verbal example on screen, so I will allow you to take a look at the example in the notes to help embed your understanding when you're private studying this on your own. Next, on page 72, we have got 2 audit standards. Now, why are we going to look at 2 audit standards together? Why not look at them one at a time? Well, I am going to look at them one at a time, but you're going to see that there is a link between them. Now, the class notes are all fine in this respect, but with technical stuff, I think reading it out is often not that helpful, and probably more useful is for me to do this up on the screen. So let's do that. So the first of these is ISA 510. It's called Initial Audits. And what that means is that this is your first audit of this client. So you have not audited them before. Of course, there could be many reasons why this is the case. It could be and most likely that a different audit firm did it last year. Or it could be that this company had no audit last year. In a lot of countries, companies are only required to have their accounts audited when they reach a certain size. So I guess there will always be an occasion where a company that's been existing for several years without needing an audit suddenly needs one for the first time. So what? Well, if you are auditing this company for the first time and auditing this year's numbers, please bear in mind that this year's numbers did not start this year. Most of them had a brought forward balance from the previous year. The numbers have grown over time. And if that is the case, in order to check if this year's numbers are right, you do need to have some assurance that the brought forward figures, in other words, last year's numbers, are also right. Because if they were wrong, then they'll feed through into this year's numbers, which will therefore be wrong. Assuming someone did audit the figures last year, as long as you can see they've done a proper audit, there shouldn't be a problem. So you're going to contact last year's auditors and just take a look at their audit work, if they'll let you. I'll come back to that in a minute. And make sure that you can see that the audit was done, there were no big issues, and everything seems okay. Now, I suppose one question is, are you going to get their working papers? Well, you are required to ask for them under the audit standard. Whether they're willing to supply them is another matter. In some countries, the audit firm from last year have no choice. They have to supply them if they're asked. All part of cooperation, they are required to do so. However, in other countries, there is no such requirement. And if there's no such requirement, you may ask and they might say no. But you're going to ask. Try and get hold of them just to give you some assurance that last year's figures and therefore this year's opening balances are safe. If there was no audit last year, and this is the first time this company has been audited, well, good question. I mean, the thing is, you have no idea if the opening balances are okay because no one's ever looked at them. And if the opening balances are feeding into your closing balances, you have no choice. You are going to have to do some work. Whoops. You're going to have to do a bit of work on the brought forward balances because many of them will impact the carry forward balances at the end of your year, and no one's ever checked them. So that is initial audits. Only an issue when you have a new client. Because if you've audited this company before, You'll know if the opening balances are okay because your team did last year's audit. So that standard covers new clients. The other standard we're looking at here, ISA 710, which has a very long name, but we'll get it down to the basics, comparatives. This is going to be an issue for every audit. And that is because every company in this year's financial statements includes last year's figures as comparatives. So in this year's accounts, you've got this year's numbers, and then next to them in another column, you've got the same numbers from the previous year. So you can see the comparison. Okay. Now this one's a little bit odd, I suppose, but in your audit report, you will say, we have audited the financial statements. Well, the financial statements are all these pages of information with the statement of profit or loss, statement of financial position, etc. And the thing is, the profit or loss and the statement of financial position include last year's numbers to compare with this year's. So when you say we've audited the financial statements, and when you say here is our opinion, that opinion must also include, since they are in there, last year's numbers. In effect, you are telling the shareholders about this year's figures, but also indirectly telling them what to think about last year's. Therefore, since your audit opinion covers both this year and last year's comparatives, when you give your audit opinion, if there is anything about last year's numbers that you would have told the shareholders last year, you're going to have to repeat it this year. So in all audits, if you know that last year's figures were wrong, and they may have been wrong last year and got a modified audit report, of course. If you know last year's figures are wrong, or if we don't know if they're wrong because we were lacking evidence last year, or if they weren't audited last year, you have to tell the shareholders in the audit report. And that's true for any audit. If, in addition to that, this is a new client, you need to do some work on the opening balances and make sure you are happy that the starting position this year was right. We are on chapter 4, my friend. Heading back there right now, page 72. And that was Audit Standard 510 and 710. Not at all. I was going to go back there anyway, to be honest. You'd timed it perfectly. Next one, at the bottom of page 72, ISA 520, Final Analytical Procedures. Pure revision from F8, not much to say here, other than to say this. During the audit, the accounts are probably changing. You're finding mistakes, you're asking the client to change them, so the accounts will get altered. Also during the audit, you are picking up additional knowledge and understanding of this client. So by the time you get to the end of the audit, the accounts have changed, your understanding of the company has changed, and therefore what you need to do at the end, before you sign your audit report, is take one long last look at the accounts and ask yourself, do these accounts fit with your accumulated understanding of this client? So that is ISA 520. Finishing off the chapter, some other completion issues as well. Auditors are very nervous and careful people. So at the end of the audit, we will start filling in checklists, going through all the company law issues we should have thought about, all the accounting issues we should have thought about, to make sure there aren't any considerations that our brain has not been considering. One other thing to think about at the end of the audit comes from ISA 450. During the audit, if you find a mistake that appears to be material, we go straight to the client and say, client, this appears to be wrong, and we ask them to change it. But we also keep a list of all the other mistakes we find that are fairly small. We wait until the end of the audit and then we add all these other mistakes up, because there's a chance that lots of smaller mistakes add up to something that overall is a big mistake. And if they do add up to that, we'll have to ask the client to change that as well. So aggregate your immaterial misstatements, go to the client and say, we also found these, are you going to change them? The client might say no, they're too small, and if they are too small, no problem. But if they're material, problem. Fantastic. Well, that is the end of chapter number 4. Yay! Other than a few accounting standards left to look at next week. And that means we can now move on and look at chapter number 5. So just to repeat, in chapter number 4, we planned an audit, we collected our evidence, we finalised. Basically, chapter 4 is sort of the F8 syllabus, the audit process, the big chunk of that paper, being revised, but then applying it to harder accounting standards. Well, audit's over now, time to do the audit report. But before we sign the audit report, let's take a little jump out of the process. We've tended to focus on auditing one company at a time. But of course, there are these lovely things called groups producing consolidated financial statements. So we also need to consider what are the additional issues if we're auditing a group. Now, if you're auditing a group and it's the same group as last year, and it's got the same structure with the same subsidiaries and nothing has changed in that respect, to be honest, there aren't that many issues. The interesting question on P7, which comes up frequently, is this. A very popular exam question is this one. Very, very popular. Slightly less, well, very much less popular, but still coming up and examined fairly recently, is the other way round. So this is easily the most popular, and you're about to find out why when you see how many issues there are. But what if your examiner decides to have a disposal during the year? Well, we're going to do the disposal first and then look at the bigger one. So, impact on our audit if our client, a group, has disposed of a subsidiary. Right, well, one potential impact of this is a practical one, because if the group is now smaller, then potentially you might need less time and less staff to get the audit finished. Less work to be done. Now, that's only a maybe, to be honest. You've still got the fact there's been a disposal during the year to audit, so maybe not until next year when the disposal is in the past, but possibly. Now, if I say to you disposal of a subsidiary, some of you will go, "Ooh, that sounds scary." Maybe with some nasty memories of some nasty calculations on P2. Don't look at it that way. A subsidiary is an asset just like anything else. So let's pretend it's not a subsidiary. Let's pretend they've just disposed of a machine. Well, if I said to you disposal of a small asset, surely what you'd want to do is check the proceeds, and you'd want to check those by looking at the cash book, bank statement, and also the sale agreement to check that the amount they've received is what we were expecting. We'd also need to check that this has in fact been disposed of. So you'd want to see a sale agreement, contract, whatever. Not just to verify how much money, but to make sure that the date that all of this has completed has passed. There should be a gain or loss on disposal, so you'd want to recalculate that, presumably. Absolutely, thank you very much. And when there's a gain or loss on disposal, it should be disclosed. Make sure it's been disclosed. There was all sorts of issues here. Don't forget tax liability may arise as well if they've made a gain. And also, if they've sold it during the year, ensure that the performance of this sub has been separately disclosed in the profit or loss, because of course this sub, if sold before the year end, would be a discontinued operation as per our good old favourite IFRS 5. Oh dear, excuse me. Now those are a few thoughts. Quite a few of those are exactly the same if you're disclosing a machine. Okay, IFRS 5 wouldn't kick in, of course, but most of the other stuff would. It's really not that complicated. Now, if that comes up, maybe 5 marks of audit work. Let's now look at something inherently larger: the acquisition of a new sub. If you see that this is happening, there is a long list of issues that you need to consider. Some of them are accounting issues, some of them are audit issues. Let's take a look. Okay, so your client has acquired a new subsidiary during the year. I'm thinking we need to check the date that control passed. That will have an impact on when the consolidation begins. In other words, the split between pre-acquisition and post-acquisition reserves. I suppose if they're telling us that they have acquired a subsidiary, we ought to check whether it is a subsidiary. It could be a sub, it could be an associate, it could be a joint venture, it could just be a trade investment. Now the key issue, of course, with a subsidiary is control. So you'd be looking for has control passed. If there's only significant influence, not control, it's an associate. If control is shared with another organisation, joint venture. If there is no control or significant influence, trade investment. But you would need to assess that. Assuming it is a subsidiary, I'm also thinking we would have to do a recalculation of goodwill. And especially if they bought it relatively early in the year, by the end of the year, enough time might have passed. We should be looking to see if there are any clues that goodwill might be impaired. I'm also thinking, has the sub got different accounting issues? Policies, sorry. Have they got a different year end? Are there any intra-company transactions with other companies in the group? Because if any of those exist, there will need to be some consolidation adjustments to deal with all of those. And what if the sub is overseas? Because if the subsidiary is based in a different country, then we will have to check their retranslation of the foreign currency, because they might have got that wrong. And also, well, we said different accounting policies. If it's in another country, they might have prepared these accounts under different accounting standards. Now, this is not a complete list of every single issue, but this is a pretty good and thorough list of things that you would need to talk about in your answer whenever a new subsidiary is acquired. This is a very useful list to remember, because now I could go and read the story and find out, is it a mid-year acquisition? Because then things like the reserves are going to be more of a pain for the calculation. Is it overseas? Does it mention the year end of the subsidiary? And if it does, is it the same as the groups? Does it give you any clues that there could be differences in accounting policies? I'll give you an example. In a recent exam question, a company, fairly old and traditional, bought a new subsidiary. The traditional company that was the acquirer didn't sell things online. the company they bought did sell things online. And that means they'll need a revenue recognition policy as to when they reflect an online sale. Is it when someone presses the button and buys something, or is it when they send the goods? They'll have to have a policy on that. And that means that the acquiring company, which will have no policy on online sales, whereas the acquiree, the company being bought, does, so we've got a difference in accounting policies. Now, with all these potential differences in accounting standards, year ends, and whoever knows what else, if they are that different, consolidation adjustments might not be enough, and you might have to instruct your client to tell the subsidiary they will have to produce 2 sets of accounts. One with their year end and their accounting rules to keep their regulator happy, but then a second set, and the second set will follow the group's rules, and that is what we will consolidate. But if that's what they're going to do, we're going to have to check that the second set can be reconciled back to the first to prove they're based on the same transactions. Sounds like lots of fun, doesn't it? But the thing is, as well as the accounting issues, there are also going to be audit issues when there's a new acquisition. So as well as all of those accounting things that the auditor will have to look at, other things that will need to be considered are this subsidiary is now part of the group and you are reporting on the group. If you don't understand this new part of the group, especially if it's a fairly big part of the group, how do you know the accounts of the group are right? You have to understand your client. If they've gone and bought a new bit of client, you need to understand it. Then there is materiality. This will go up because the group is now bigger. So compared with last year, materiality figures should be higher. You also need to assess how material is the sub to the group, because that is going to impact things like the amount of time and staff needed for the audit, and will also impact how big a mistake would have to be at the subsidiary before it was material enough to affect the consolidated accounts. Do bear in mind that the subsidiary is obviously only of a certain size, the group will be much bigger, and that means there might be mistakes in the subsidiary which are enough to modify its audit report, but are not material enough to impact the group audit report. And one other thing with materiality, if the sub is bought late in the accounting year, so fairly near the year end, then it's not going to have a huge amount of impact to the performance of the group and therefore to its accounts. And potentially that impact might not be material at all. Now, if a company has bought a new subsidiary, it will have to at least tell the shareholders it's happened during the year. But if you buy a new sub on the last day of the accounting year, it's not going to contribute much to the numbers, is it? So potentially it doesn't get consolidated at all. Immaterial. But there's more. Thing is, when this subsidiary joins the group, the subsidiary will have its own audit firm already. And that audit firm will be partway through an audit, presumably. And the group are therefore likely to let the existing audit firm finish this year's audit, after which your firm will probably be invited to take over. It's more efficient that way. But it doesn't make sense to stop the current auditors halfway through the audit and make you take over. It will probably cost much more money done like that. Let the current guys finish. Now, for the company, that's fine, but for you, the auditor, this is a little bit of a pain. Because if that sub is going to be audited by another firm, now the subsidiary is called a part or component of the group. So if they are audited by another audit firm, this is known as a component auditor. If the sub is audited by another firm, but the sub's figures are going into the consolidated accounts, which you are giving an opinion on, you'd better be sure that that other firm of auditors has done the job you think they have. So you are going to have to review their work. Potentially, not just at the end, but reviewing their planning to make sure they're planning to do the audit that you want them to do, and then review things at the end to make sure they've got enough evidence as to whether these accounts are true and fair. But it gets more interesting. You see, if this subsidiary is in the same country as you, so the audit firm is in the same country as you, at least you know they're bound by the same code of ethics, they're following the same audit standards, their work is being monitored and regulated just as your firm is. Should be fine. But what if the component auditor is an overseas firm? Now, if your subsidiary that your client has bought is overseas, there's a very strong chance their auditors are in that country as well. We, of course, are required to be independent of our clients. Why is that? Because the ACCA has a code of ethics. This overseas firm, do they belong to an institute? I mean, they might do. But in some countries, there is no Institute of Auditors. In some countries, there is no code of ethics for auditors. And if there's no code of ethics, how do you know that the audit firm is not the finance director's friends or relatives? I mean, it could be. So you are going to have to check the ethical code they follow to assess whether their behaviour is of a similar standard to yours. If it is, fine, they're trustworthy. If it isn't, there's no guarantee that they've done this audit in a professional manner. I'm not saying they haven't, I'm just saying there's no guarantee that they have. In the United Kingdom, as in most countries, audit firms get a regular visit from the monitoring unit to check the quality of their work. This gives assurance to everyone that British auditors, American auditors are at least doing somewhere close to professional work. What about this overseas firm? What happens in their country? Is there any monitoring? And another thing, in the United Kingdom, we follow the international standards on auditing. A lot of countries do, and a lot of countries don't. So if this other audit firm are likely to follow different audit standards, there's no one monitoring their work, and there's no ethical code governing how they do their work, you're going to have to look at this and think, well, I'm going to have to check what they do very carefully because it doesn't sound very reliable. And if the audit standards they're following are very different to the audit standards that you follow, there could be bits of audit work that you're assuming they will do that they're not going to do because there's nothing telling them to do it. So you may have to instruct this other audit firm, here are additional things we need you to do. And if they have no idea what you're talking about, you may have to go and do it yourself. Now, all of this is not going to be an issue on a regular basis. But if your client has bought a subsidiary in a relatively underdeveloped country, this is going to have to be looked at. Whoa. So you can see that if your exam question says, what is the impact of the acquisition on your auditing, you then read the story and your client has acquired a new subsidiary in a foreign country, in a different industry that has its own auditors, you have got a lot to write about. You will notice that in covering this area, I've not even opened the chapter. I've done the whole thing up on the screen. And there is a deliberate reason for doing that. I think everything I've written up here is not that difficult. Most of it you'll be going, oh yeah, that's a good point. Which means if you read the notes, it's not going to have much impact on you learning it because you'll just be reading it going, yeah, that's a fair point. If you want to be good at group audit, the best way is very simply to take out a blank sheet of paper and do what I've just done, because I have no notes in front of me. When we go through chapter 5 now, we'll see a lot of the things in there I've put up on the screen. It won't be absolutely everything. But the best way to prepare for a groups question is a blank sheet of paper. Ask yourself, if my client's acquired a new subsidiary, what things will I have to check? Okay then, well, we've had the fun by trying this up on the screen. What we need to do now is go back to the class notes and see how much of the class notes I've managed to talk about. Now, there are some other things in chapter 5 as well. It's not just about a new acquisition or a disposal. There's also the ongoing things which will be relevant to any group audit, and also a rather interesting current issue. Let's pick it up on page 78. Whoops. Is there any ISA that covered the component auditors? What a beautifully timed question, sir. Yes, there it is, look. ISA 600. Now, ISA 600 covers a lot of group issues, but predominantly they are the issues that arise when there is a component auditor. Another audit firm is auditing part of the group. So, good question. Okay, so if there is another audit firm involved, what are the issues? Well, we need to consider the materiality because if this is a tiny subsidiary, I won't check the other audit firm too much because it doesn't have much impact on the consolidated accounts, does it? If, on the other hand, this subsidiary makes up half of the group, I'd better check the other firm's work a lot because it has a big impact on the consolidated figures. I'll need to see if I can rely upon these guys' work by checking, are they professionally qualified, are they experienced, are they independent of their client, are they following a code of ethics, is their work being monitored, etc. I'm going to have a look and see if they are doing the audit I want them to do. I'll review their plan, and if I don't think they're doing everything I want, I will instruct them to do additional things. If there is a problem with them doing those additional things, I may have to fly out and do them myself. And I will consider the audit standards and audit regulations, because potentially, if they're different to what I'm used to, I may have to instruct them to do additional things on top of the normal standards. And if I'm worried that their work is not very heavily regulated, I'll have to review it in a lot more detail. A fairly minor point underneath that, but worth a quick note. If you are signing off the audit report in the consolidated accounts, you and nobody else is responsible for that opinion. If it turns out that a component audit firm has made a mess of it, you didn't spot they'd made a mess of it, so you say the group accounts are right, when in fact one of the subsidiaries in that group, their accounts were rubbish, I'm afraid it's your responsibility. And typically in the audit report, you are not allowed to state that any other audit firms have been involved, because that might be seen as trying to deflect your responsibility. Now, I mentioned a current issue, and here it is. It's called joint audits, and just before we go through this and continue, I'm just going to take a little 2-minute break. I've been doing this all day today. I'm really struggling with voice at the moment. I know I don't normally take a break, but tonight, to allow my voice, which is extremely tired, and I've got an infection as well, just to make sure I get through to the end of the class without my voice disappearing, let's have a little 2 minutes, a chance to breathe and reflect, and when we come back, we'll take a look at joint audits, okay? Just 2 or 3 minutes break, that's all. So don't go far. Okay. Nikita is here. Excellent. Always nice to see someone. Did any of you manage to open the past live recordings? It's still locked for me here. Ooh. If that's still a problem, if you can email me tomorrow, Nikita, or I'll have a chat with admin and see. No one's raised this before, so I'm guessing it's an issue for you rather than an issue for everybody. But if you drop me an email and I'll forward it on to our admin and we'll get it sorted out for you. Okay, hopefully that break will get me through the next slightly less than an hour. So then, we were about to look at joint audits. Oh, there was a problem with the weekend, was there? I don't know, to be honest. No one's mentioned this to me, but yeah, there may have been. They might have been doing some work on the system. So every so often they do have to shut it down for a little while. So apologies for that. Yeah. Right. But it all seems to be up and running now by the sound of it. So hopefully Nikita can get in there. Right, joint audits. What's this all about? Okay, what is a joint audit? A joint audit is where two audit firms will do the audit between them, and then at the end there will be one audit report with one opinion, but signed by both audit firms. So you can't have one saying the accounts are right and one saying the accounts are wrong. Okay. Not quite sure why ISA 600 is getting a mention for some reason, but anyway, we carry on. So two audit firms jointly doing the audit, but submitting one audit report with one opinion that they both agree to. Why on earth would you do that? Well, think of the potential benefits. Now, don't get me wrong, the costs of this are going to be annoying because two firms means extra cost for companies and the audit will take longer. It's not like they're going to share the work out and double the resources makes half the time. No, I'm not signing that opinion unless I've checked everything. Both firms will want an involvement in the checking of anything important. So the audit will take longer and it's likely to be more expensive. So why on earth would you do it? Well, two heads are better than one, more expertise. You can certainly see some logic in that. And on a big, complicated audit, maybe it's a good idea. The reason we're looking at it here is that in a group situation, where there's a subsidiary being audited by another firm, but your client has already told you that next year, you, the group auditor, will take over the audit of that subsidiary. There is a logic in saying maybe what should happen this year is that the existing auditor and the group auditor should do the work together. That way you get a sort of gradual handover of information about the client, gradual improvement in understanding, so that when the group auditor does it next year on their own, they know more about the client than they otherwise would. Well, there's one reason for doing it. A second reason is the argument I just gave, where you have a big, complicated audit. Maybe we should have two audit firms just for safety. But there's another reason that joint audits have been proposed as well. At the moment, the auditing industry is dominated by four big players. And you know the names: PricewaterhouseCoopers, Ernst & Young, EY, Deloitte, and KPMG. And there is some concern that with those four cornering the market, that maybe there will be quality issues and maybe prices will rise due to a perceived lack of competition. And we're starting to get to a situation where the firms next down the list, you know, firms 5, 6, 7, 8, 9, etc., are saying they can't get to audit any big company because they've got no experience of auditing big companies. It's a bit like, you know, when you try and get your first job and the employer says, no, I want someone with experience, to which you say, how am I meant to get experience if no one will ever give me a job? Fair point. Well, it's sort of becoming the same in the world of auditing. So how can these next firms down the list, these not quite so big audit firms, get experience of auditing big companies? And some have suggested that one way to do this is to tell all big companies they must have 2 auditors sharing the work, and one of the 2 firms cannot be Big 4. That would guarantee that the next firms down, firms 5 through 15, let's say, would get to share some big audits, would get big company audit experience, and that means in the future they would find it easier to tender against the big boys because they'd have some experience on their firm's CV. At the moment, joint audits are done in some countries. They're quite popular in France, for example. They're not used much elsewhere. But it has been a talking point over the last few years that maybe to improve competition in the industry and for a few other reasons, as I just described, that joint audits might be a good idea. So, potential discussion question, maybe 4 or 5 marks. It has come up on a recent exam, I think 3 or 4 sittings ago off the top of my head. So it has come up, but it could come up again, maybe. Moving onwards, practical issues with groups. Comfort letters, I will come back to those in a minute. Then the rest of this page, different year ends, accounting policies, materiality, knowledge of client, are all issues that I raised already before we even opened the chapter. But what about comfort letters? What are they? Okay, let's imagine we have a parent and a sub, and you audit the sub. Now maybe you audit the parent as well, I don't really care. Let's focus on your audit of the subsidiary. Whenever we are auditing a company, one of the things we need to do is assess whether that company is a going concern. So we look at how much money they've got, how much money they could get, how much money they need to try to understand whether this company is likely to survive. But we also need to look at their providers of finance. So we look at their relationship with their shareholders, their relationship with their bank, things like that. Where a company has got hundreds or thousands of shareholders, it is highly unlikely that all of those shareholders will get together one day and decide to shut the company down. They could do, because if it's their company, they can do what they like with it. But realistically, that isn't going to happen. On the screen, we have a situation where this subsidiary does not have thousands or hundreds of shareholders. It has one, a parent company. And the simple fact is that the parent company, since it is the only shareholder, can do whatever it likes. And if it decides this subsidiary is becoming too expensive to run, or it doesn't feel it's got a good long-term future, it could decide to close it down. The going concern status of that subsidiary is very heavily dependent on the parent. So if you audit that subsidiary, when you are assessing its going concern status, there are two things I suggest you need to do. One, you need to get a letter from its parent company confirming their intention to continue supporting the sub. And that's what we mean by what it said in the class notes, a comfort letter. It's almost like trying to understand if a child is going to be financially viable on their own. Well, the child relies on the parent, so if you're a bank and a child walks in and says, "Hello, I'd like to open a bank account," well, you'd want to talk to their parents, wouldn't you? It's a bit like that with subsidiaries. Some of them can stand on their own 2 feet, but some of them rely very heavily on the parent for their finance. And if they've got virtually no bank loans and all of the money's coming from parent, if the parent wants to close them down, that subsidiary would have nothing left. The other thing I would do is getting a letter from the parent is helpful, but I would now want to check that the parent has the resources to support the sub. Saying it is your intention is one thing, but if that subsidiary needs a lot of finance, potentially saying it is great, but is not going to be enough to actually do it. So there we go. That is a comfort letter. Not examined very often these days. And that is what we saw at the top of the screen. Moving down onto page 80, some other accounting issues. Again, I think most of these we've dealt with. So we've talked about goodwill being recalculated. We've also talked about intracompany stuff being removed, checking what type of investment it is. Oh yeah, there's one at the end there I didn't mention at the beginning. Often within a group, one company will guarantee, for example, a bank loan of another company within the group. And if that's the case, these things need to be disclosed in the accounts. They become related party transactions for the individual companies, etc. Auditing a group is a very practical thing. You need to audit it in the right order. And you can't audit the consolidation of it at the end until you know that the individual accounts that are being fed into that mixer are correct. So you need the individual audits to be done to a tight timetable. Otherwise, the people doing the consolidation audit will be sitting there waiting because they haven't got all the information. Also, if you've got several companies in a group, what you want is for them all to supply information to the middle in the same basic format. So typically a consolidation pack will be sent out to each part of the group being audited to make sure that all the information you get back is in the same format. Once all the information comes back, we then have to audit the way it is consolidated. So we will make sure that all of the figures in the consolidation calculation do match the financial statements of each of the companies in the group. We'll make sure it adds up, although of course these days it's likely to be a spreadsheet. So rather than checking it adds up, we're more likely to check the formulas in the spreadsheet are right. Any consolidation adjustments will be recalculated. We'll take another look at goodwill, reserves, etc. Make sure they've got those right. Bear in mind the consolidation schedule itself will have brought forward consolidation figures, so we'll check those back to last year. Make sure that We can get from opening reserves to closing reserves, and we understand that the numbers all make sense. And there you go, my friends. You've just audited a group. So I'll say it one more time. The most common exam question is changing group structure during the year, typically a new acquisition. How does this impact things? That was the exercise we did at the beginning. You might be asked about the specific issues of ISA 600, where there is another firm of auditors involved in the audit. So that's important stuff too. But the best way to practice this chapter, blank sheet of paper and say, right, if there's been an acquisition, and then scribble down as many thoughts as you can remember. Right, fantastic. Isn't this going well? Doesn't feel that long ago that we finished chapter 4, and now, amazingly, we've finished chapter 5. We're racing towards the end. At this rate, we'll finish everything by 8:30. No, that's not going to happen. But we are going to get through chapter 6 as well. Audit reports and other reports. Now, most of this chapter is about audit reports, absolutely. But we also need to look at reports to those charged with governance. Again, that is stuff from your F8 syllabus, so it's all revision. The one thing that's a little bit not revision is 3, because other reports starts to look at non-audit assignments. Okay, so audit reports. What exam questions can you expect about audit reports? Well, there are 2 basic styles of question. In the first one, there will be a scenario, a story, and you have got to describe what you think the impact on the client's audit report would be. And that basically involves picking from the 7 potential outcomes that we get in audit reports. As long as you understand the 7 outcomes, it's not going to be too difficult. The second one is a little bit more challenging, because with this one, your examiner gives you an audit report. So the actual report itself, or part of it, and your job is to criticize it. That could involve saying that the outcome that they've chosen from the 7 available is the wrong outcome, but it's likely to involve a lot of other criticisms as well. Well, we can't criticise an audit report till we know what it should look like. So what we're going to do is go through the notes, go through the 7 outcomes, all of which is revision from the F8 syllabus, and therefore, as I'm going through it, I'm hoping that you'll be sitting there going, yes, I remember this. And then we'll take a look at the criticism aspect of this at the end. Firstly, what goes into an audit report? Well, a lot of the standard content of an audit report is not very exciting for this exam. It's too standardized, it's just knowledge, it never changes audit to audit, and as such it's adequately covered by the F8 exam. So these top 4 things and the bit at the bottom are not really very important. For P7, so yes, the title of the audit report will say Report of Independent Auditor, the addressee who gets the report, shareholders. The introduction will say we have audited financial statements, and the responsibilities will describe the responsibilities of both the directors in preparing the accounts and the auditors in auditing them. Boring. Far more interesting for the exam are these two bits. Because this is where we are going to get the action. This is where stuff changes. Now, just before we go any further, as some of you will be aware, and in fact I've mentioned earlier in the course, audit reports are about to change. In fact, some audit firms have already decided to adopt the new format. The new format is not examinable in terms of an actual audit report question, but it is a potential discussion question as a current issue. So we have to learn the old format or current format audit reports first. Then when we get to current issues next week, we'll consider the new one. The basis of opinion and opinion sections, by the way, the opinion is obviously where we give our opinion, are the accounts true and fair. The basis of opinion is where we explain why we're giving the opinion we are giving. And that's going to be of particular relevance when the opinion is modified, because you need to explain why you are modifying it, what the problem is. Before we get to the detail of that, there's a little section at the bottom of the page. Standardised audit reports looks at the pros and cons, the advantages and disadvantages of the fact that audit reports are very formalised, follow a standard pattern, a standard content. Now, it's pretty obvious stuff. To be honest, the pros and cons of standardising audit reports are the same as the pros and cons of standardising anything. Good thing is familiarity. Everyone's dealing with the same type of document time and time again. That's good for auditors, good for shareholders as well. And by formalising a standard level of content, we can make sure all audit firms put in the minimum that they should. The bad news about having a standardised content is auditors will only put in the minimum. If you say, here's what should go in, you're sort of indirectly saying you don't have to put anything else in. And for audit firms who don't want to say too much for fear of being criticised, that's exactly what they'll do. So over the years, there has been criticism that audit reports have become boring, useless. They say virtually nothing about the individual company that's been audited, and instead they're full of lots of standardised language without really learning much, if anything, about the company that's being audited. Now, as I just said, that is all up for change at the moment, and we'll investigate that next week. But for now, it is time for us to look at the 7 potential outcomes that an audit report can have. The class notes cover all of this, but because we're going through several possibilities, I think maybe what you need is to see all of this as a diagram. Some of you might have heard the number 7 at this point and be thinking, I could have sworn there were only 6. Well, if you studied F8 a few years ago, there were only 6. In 2010, it became 7. Okay then, here we go. 7 outcomes of an audit report. The first one is the standard, unmodified report. This is the audit report suggested by ISA 700, Audit Standard 700. And when I say it is unmodified, what that means is the financial statements are considered to be true and fair. and there is nothing else to report to the shareholders. Now, in the real world, that is the most common audit report. If you pick any 10 companies you've heard of and go take a look at their website, go find their annual report, go find the page with the audit report on, I bet you at least 9 out of 10, and probably all 10, are that. Boring. Of course, in the exam, we're going to get some excitement in the question, and it probably won't be that answer. But in the real world, that is the example that's very easy to find because there are thousands of examples. There are then 6 modifications to the audit report. And of those 6 modifications, 4 involve modifying the opinion, and the other 2 are unmodified opinions The reason the report is modified is not the opinion changing, that stays the same, but you get an extra paragraph. Okay, so just to be different, let's look at the 2 unmodified opinions, but with the extra paragraphs. Because we've done one of those already tonight, in fact, so we may as well do that first, I guess. What colour shall we have? Let's have green for these. Okay, firstly, the one we saw earlier tonight. If there is a mistake in the unaudited sections of the annual report, these unaudited sections being known as other information, then as auditors we need to tell the shareholders about this mistake, and that is known as an other matter paragraph. So maybe a useful way to remember this, if there's a mistake in the other information, it relates to an other matter paragraph. If, on the other hand, there is something which is correct in the financial statements, but it is very significant, then the auditor is going to draw the shareholders' attention to this by highlighting it. And that is called an emphasis of matter paragraph. Now notice the difference here. One of them involves a mistake, the other involves something correct, so that's one way to think of the difference. One of them involves a mistake in the other information, the other one is something correct in the financial statements. In both cases, notice, the opinion is unmodified. That's because the financial statements are fine, they're true and fair. But in both cases, there's something you want to highlight, either because it's something in the other information that is wrong, or it's something in the accounts that's right, but so important you want the shareholders to know about it anyway. So you make absolutely sure they've read it. In both cases, the extra paragraph goes under the opinion section. So in both cases, that is true. And there you go. There's your 2 extra paragraphs. And those 2 extra paragraphs, by the way, are covered by ISA 706. These modified opinions over here, ISA 705. So now what we need to do is move on and remind ourselves about the 4 modified opinions. Now, clearly I'm not going to have space in here, so let's come down here. Right, 4 modified opinions. Now, when we modify the opinion, we change our opinion on the accounts. There are only 2 reasons why we do it, but for each of the 2 reasons, there are 2 levels, and 2 times 2 gives 4. The 2 reasons are the financial statements are wrong, fairly obvious reason to change the opinion, and the other reason to change an opinion is a lack of audit evidence. Okay, let's imagine the financial statements are wrong. 2 levels of problem. If the financial statements are really wrong, I mean they have really screwed them up, so you've got lots of mistakes affecting lots of the figures, we call this pervasive. Pervasive means something that affects everything, it gets everywhere. And this leads us to give something called an adverse opinion. Meaning we are going to say the accounts do not give a true and fair view. So if they've really made mistakes, huge mistakes, the accounts are just plain wrong. If, on the other hand, they have made a material misstatement, so the accounts are wrong in a material way, but not pervasive. In other words, a small number of figures are affected. Well, if it's only a small number of figures, it should be possible to separate the ones that are affected whilst telling the shareholders that the rest of the accounts are okay. What we do here, therefore, is we give something called a qualified opinion. Meaning we are going to use the words except for. So what we do is above the opinion, in the basis of opinion section, we explain what the problem is, and then underneath in the opinion it says, except for the adjustments required to correct the above, the financial statements give a true and fair view. So if we can separate the problem, we separate it. Now you know that there are meant to be 4 things happening here, and if you're looking at this screen, you may well be thinking, how's he going to fit another 2 in? The answer is, I'm not going to fit another 2 in, I don't need to. Because if you are lacking audit evidence, and there's a material amount of evidence missing, but it doesn't affect everything, it only affects a few balances in the accounts, you can say in your basis of opinion, this is the evidence that is missing, except for any adjustments which might have been necessary. You don't know, do you? Because you've not seen the evidence. Except for any adjustments which might have been necessary, the accounts give a true and fair view. If, on the other hand, you are missing evidence which affects lots of balances, then you have got a problem, because this is called pervasive again, and if you're missing that much evidence, how can you give an opinion at all? So now what you do is you give a disclaimer of opinion. In other words, you are going to say, we cannot or do not give a true, we cannot give an opinion. So we end up with 4 ways of modifying the opinion. 1's there, 2 there, 3 there, and 4 there. Yes, okay, 2 and 3 both involve the words except for, but one of them says this is wrong, except for that everything's fine, and the other one says this might be wrong, except for that everything's fine. So it's not quite the same thing. And in an answer, you do need to explain it clearly, so they are separate. So there we go, my friends. There are 6 possible modifications to your audit report. 2, leave the opinion untouched and just add an extra paragraph. The other 4 all change the opinion. As I said before, but I'll just write it down, in all 4 of these cases, you explain the modification, so explain what the problem is, above the opinion in the basis section. So explain the modification above the opinion in the basis section. Notice the difference, the 2 extra paragraphs where you don't modify the opinion, those paragraphs go underneath the opinion. Okay? Right. Apologies for that. A little bit of noise going on next door and they need to calm it down a bit because you're probably hearing all of it. Oh dear. Overexcited people. Really ought to be going home at 20 past 8. Just shows how hard we work here. Okay, well I've taken you through the various possibilities there. So for a scenario, you now know what you need to do. If it says, what's the impact on the audit report? You ask yourself, are we missing evidence? Because that could be 2 of the possibilities. Are the accounts wrong? That raises another 2 possibilities. You'll have to assess how material the issue is. Is it pervasive? And if it's none of those, ask yourself, is there something really important in the accounts that should be highlighted? Or are they talking in the question about mistakes in the chairman's statement, the integrated reports, the corporate governance disclosures, in which case it's an other matter. What if the question says, here is an audit report and asks you to criticise it? What sort of things should you be criticising? Well, the first thing I'd probably look at, we've just seen that there are 7 possible options for the outcome. Work out which outcome they've gone for, look at the story and ask yourself, could we justify a different outcome instead? The answer is you probably could. But what else are you going to criticise? Well, clarity. Read the audit report. Is it well explained? Or when you read it, are you confused? And trust me, if you're confused, the shareholders will be confused, and that makes it a bad report. Consistency. If one sentence in the report is suggesting there's a problem, whilst another sentence in the report is saying there are no problems, shareholders will get confused. So if there are 2 sections contradicting each other, that would be a problem. Detail. Is there enough? Are there additional things that the auditors could have told the shareholders? So, for example, if there is a misstatement, so the accounts are wrong, does the auditor quantify that misstatement? It's all very well saying naughty company, they should have put a provision in the accounts, but if you don't tell me how big that provision should be and what the impact on things like profit is, I'm not going to get it, am I? Are the sections in the right order? So if there's a modification to the opinion, it should be explained above. If there's an extra paragraph, it should be below. Are the headings appropriate? There should be headings in an audit report to help guide the person reading it through the various sections. Again, I'll give you an example. If there is a disclaimer of opinion, then the opinion section at the end cannot say opinion. Because if it says opinion, and in it it says we aren't giving an opinion, well, it's not doing what the heading says. So if there is a disclaimer of opinion, then the opinion paragraph should be headed up, disclaimer of opinion. Things like that. Are the headings sensible? And maybe one more thought on this. Is it written professionally? If there is a mistake in the accounts, all you have to do is explain the mistake. You do not write in an audit report that the finance director has deliberately made a massive mistake in the accounts. No, keep people's names out of it. Just say this is what's been done, according to the accounting standard, this is how we believe it should have been done, and here's the impact. No need to start making accusations, things that could end up with you in court, or frankly being punched in the face by a client. Not good. Okay, now that is about it for audit reports. Back in the class notes, after the notes go through all these various possibilities, you'll find on page 87 a nice little example. That would be a useful additional homework exercise for you to have a go at. It is not that complicated, but it's there just to remind you how the audit report outcomes work. So useful practice. There's a couple of other sections on pages 88 and 89 I'll come back to in a minute. But just so you know, from page 90 onwards, I've added a few real audit reports to the class notes. Now, I'm very much of the opinion that it is much better if you go out and look on companies' websites at real audit reports from this year, but there are a few examples in the class notes for you to have a look at. But to finish off tonight's class, let's go back to page 88 and just move away from audit reports on financial statements to just look at a little bit of other reporting. There are a couple of audit standards that involve reporting to management and to those charged with governance. When we say those charged with governance, we are typically talking about the audit committee. All of this is from the F8 syllabus, so a nice easy bit of revision to finish off the evening. And according to audit standard ISA 265, when we do an audit, we have assessed our client's controls. Why have we done that? Because good controls means we can reduce our level of substantive testing. But if we are assessing our client's controls and we find deficiencies, we find problems, it would make sense for us to report those problems to our client. And we do that by highlighting the deficiencies, the consequences of those deficiencies, and making recommendations to improve. Now, it's fairly unlikely on P7 that you'd get much on this on the exam, purely because it's tested so much on the F8 paper. So this is not very important for P7. But you are meant to know the stuff from F8, and she might ask something about it, so certainly worth knowing. But in addition to that document, over the years, recent years in particular, corporate governance has become a bigger and bigger issue. And as it's become bigger and bigger as an issue, the role of the audit committee in corporate governance has got bigger and bigger. And those writing audit standards have realised that there are a lot of reasons why the external auditors need to talk to the audit committee. That is what ISA 260 covers. And you might be asked, what sort of things should the auditors be discussing with the audit committee? Now, it's worth pointing out now that some of the things we discuss with the audit committee are not in these audit standards. They already existed in others. So, for example, ISA 240, fraud. If you think you've discovered fraud at your client, report it to the audit committee. ISA 250, laws and regulations. If you think your client's breaking the law, report it to the audit committee. And we saw those two ISAs way back in chapters 1 and 2, I think it was, of the class notes. But ISA 260 says, hang on a minute. If the audit committee's role in corporate governance is to make sure that the accounts are okay and that the audit of them is going well, surely the auditors who are auditing the accounts should be talking to the audit committee the whole way through the process. Now, I'm not going to read the class notes out at you because that doesn't help anybody. What you want to know is, how do I remember this in the exam? And my message to you is, if this question comes up, what should auditors communicate with audit committees? Just think through the audit process and what the issues are, because all of them will get communicated. So at the start of the audit, even before you've said yes to being the auditor, you assess threats to your objectivity and put safeguards in place to deal with them. Well, you don't just do that, you discuss the threats with your audit committee, your client's audit committee, and discuss the safeguards you're proposing to do. Once you've been appointed, you plan the audit. You start at the strategic level, looking at things like the client's deadlines, a rough timescale of what you'll do. We'll talk to the audit committee about that. And when you're doing the detailed audit risk analysis and the business risk understanding, talk to the audit committee about this. Let them know what risks you think are important. They might tell you there are other risks important as well. Okay, you've now planned the audit, now you do the audit, you collect evidence. Well, if you've got any problems collecting the evidence, maybe the finance director is refusing to cooperate, tell the audit committee. Now you're into finalisation. Maybe you need management representations and maybe management are refusing to give them. Tell the audit committee. Maybe there are some mistakes you discover during the audit that the client doesn't want to change. Tell the audit committee. And now you're putting together your audit report. Especially if you're planning to modify your audit report, explain why to the audit committee. Maybe this is a problem that the audit committee can help resolve so you don't have to change your audit report. So ISA 260, there's stuff in the notes about it, but to be frank, the best way of understanding 260 is just to think through the stages of the audit process and ask yourself what the big issues and potential problems are, because any of those should be discussed. Now I've got some good news, because the last bit in the chapter, looking at other reports, is a beautiful lead in to chapter 7, and because of that, I'm going to leave that tonight, not cover it now, because it's a great way to introduce the chapter next time. Whoa! Well, haven't we done well? Now, you may well have looked at the number of classes left and thought, wow, we've got a lot of chapters to do in only 2 evenings, and yet tonight we've pretty much finished chapter 4, and we've done 5, and we've done 6. What have we got left to do? Well, chapter 7 looks at non-audit assignments. A lot of it is general stuff that covers a lot of non-audit assignments, and then we look at a few examples. Doesn't take that long. We've got a little bit of chapter 4 to finish. A couple of minor points just to make sure we've covered all the angles. We'll do a little bit of work on what we were covering tonight, just to see how it comes up in question. And we'll finish with some current issues at the end. But apart from that, that is it for tonight's class. Can I just back up what my lovely admin are saying in the chat room there? Please, 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 we do need feedback on courses. If you've got anything you think we should be doing better, please tell us. We want to know. If there are things that we're doing fabulously well, please tell us that as well, because it cheers us all up after a long day and evening of teaching and administering. Apart from that, thank you all very much for your comments during the evening and for playing along. That is it for tonight's class, and I will see you in 1 week's time when we bring the tuition phase of this course to a close. If you've not already signed up for revision, do so. You can see I don't get to do many questions during tuition because I have to get you through the material. We do some, but not as many as we'd like. Revision is where you get to see technique, 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 questions, questions, questions. Thank you, thank you, thank you, thank you. Nikita, I will try to get well soon. It is heading in the right direction. All right, guys, thanks a lot. See you next week.